Happy Saturday, everyone. Happy Saturday. We're going to give you some time to come on in and join us this morning. Building Dreams Foundation is a not-for-profit, 14 years, and our goal is to build wealth in our communities and teach you all the things that you need to know to build your own generational wealth. Today, we are going to be talking about taxes. Taxes are going to be the tax day is coming up this week on the 26th, and you are going to have the right to go ahead and file those taxes. So before you filed your taxes, I wanted to bring Ms. Patrice Stewart on so that way she can talk about all the things that you need to know. One thing about my wealth is that I never knew about tax strategy, right? My husband and I have been filing separate for years. We've lost thousands of dollars for that. And when you make business decisions, I make my business decisions and then I call my tax person. You really should have your business ideas, talk to your tax strategist, and then execute your plan, because we run around every day trying to make money, but we're leaving so much money on the table just because we don't have good tax strategy. So I am actually on my own journey of building wealth as well, and I'm kind of taking you guys along my way, and tax strategy is my number one priority for 2026, because I really want to make sure that I have my taxes in play and I'm not leaving thousands of dollars on the table. Because guess what? If I want to go flip a property and make $20,000 and tie up my time and my capital, but I can make $20,000 by filing my taxes properly, I prefer to make my $20,000 from my tax returns, because that requires none of my money, none of my time, and that is free hanging fruit, that is pretty much on the table for me. So Building Dreams Foundation today, you all know we have our Black Friday Wealth Symposium every year on Black Friday in November. If you guys don't know when Black Friday is, that's the day after Thanksgiving. And this year we are going to be having a monthly event every month leading up into the Black Friday. And hopefully you guys are tuning in, because today we're talking about taxes. Next month we might be talking about estate planning and then the stock market. But we are giving you free information so that way you can have your strategy together. And then when you come on Black Friday, you'll be ready to execute versus just kind of learning on that day. So that's pretty much what our plan and our strategy is. I am so excited to introduce you guys to Ms. Patrice Stewart. Patrice is an amazing person, number one. Number two, she just knows all of her stuff, and she knows it on a level of relating to you, right? So she can have a conversation with you, she can relate to you, and she can kind of break it all down. And I know we're talking about taxes today. I'm gonna let Patrice introduce herself, because she does so many different things. She's actually doing some not-for-profit things for my son right now, and she is just a wealth of knowledge, and I am so excited to introduce her so that way she can go ahead and share all this information with you guys this morning. So Patrice, I'm going to go ahead and hand it over to you. Like I said, we are going to be talking about wealth every month: financial literacy, home ownership, credit and budgeting. How much are you making? How much money are you spending? How can we retire successfully? That is our mission through Building Dreams Foundation. And yes, I am a loan officer, and I'm going to teach you mortgages, but mortgage is just one pillar of wealth. There is so much more. And it's one thing to get a house, but the education that we're going to be teaching you is how you keep that house, how you utilize that house for tax strategy, how you do so many different things to build that wealth. And this is on a regular 101 level. And this information is coming to you for free, compliments of Building Dreams Foundation. So Ms. Patrice, if you want to come on in and tell us everything about taxes, I'll remove my screen so you can go ahead and join.
Thank you so much for having me this morning, Miss Natasha. I appreciate you so much. So I'm gonna go ahead and let me pull it up, make sure I'm in present mode. All right.
And I hope y'all ready, y'all, because there's so many awesome things about taxes. I was texting Patrice today and just saying, hey, I saw this on social media. I saw this on social media. She was like, well, it doesn't quite mean that, right? So you'll see a lot of different stuff just for people to reel you in and pay this money or do whatever they're trying to do. And what I love about Patrice is that she's going to give you the facts. And she's going to tell you the truth, and she's not going to bait you to tell you something that's not true just to kind of reel you in. Because she was like, no, you need to understand this, you need to understand that. And I kind of love how she breaks it down. So go ahead, Miss Patrice, and tell us all about it.
Okay, can you see my screen? Am I on the right screen? Does it say
ma'am.
Tax Strategy Day Talks with Patrice? Okay.
Yes, ma'am.
So again, thank you so much, Natasha, for having me on. I am Patrice L. Stewart, better known as the Realist Tax and Business Strategist. And today we are just going to have some tax talk, right? I like to keep it kind of open and friendly, so that way if you all have any direct questions, we can just kind of go over those directly. Just a little bit about me. I have over 22 years of experience in the tax and finance space. I worked in corporate America for a decent amount of time, I'll say. And I worked for a big box bank. And in 2008, I decided to open up my own company. While I was working in the accounting space, I realized that a lot of people needed tax and business help, right? So I actually started my company, P. Stewart and Associates, back in 2008, while I still was, as we like to say, climbing that corporate ladder, right? But in 2013, I got let go, and I decided to just go ahead and actually take my business and embrace entrepreneurship really full time. And really, when I did that, I really dived into the tax code, and I'm a more say the business tax code. And that's really where I learned that we are not taught what we really need to be taught when living in the United States of America, right? And many of us are entrepreneurs and business owners, but really are not taking advantage of the business tax code, right? So these last 12 years since I've been out of the corporate scene, I've really paid more attention to bringing entrepreneurs up to date with more of the tax code, and then also empowering more employees to become entrepreneurs, to start businesses, because this is really how we take advantage of the actual tax code, as I like to say. So let's just go ahead and kind of dive right on into it. So some of the things I'm going to talk about is this big, beautiful bill. Everyone doesn't believe it's beautiful, but that's what it's called, right? Some of the top financial mistakes that I see. If we have a nice amount of self-employed people, then I do have information for them as well. And then some tax do's and don'ts, especially, I think, Natasha, you'll agree to some of those tax do's and don'ts being in the lending space and what we see in the real estate world. So let's start off with the first thing, which is this bill, right? And everyone is talking about this, which is no tax on tips and overtime. Right. So I kind of just wanted to give a little more information as far as the tip deduction. Right. So the tip, the no tax on tips is more for service workers who can deduct up to, let's say that, because I also like to be specific in when it comes to taxes in the IRS. Everything is an up to dollar amount. It's not an automatic. Right. So you can deduct up to $25,000 in tips. And that income phase out is you can't make more than $150,000. So if you made $200,000, you will not be able to deduct that. All right. If you're married filing jointly, you can make up to $300,000. So basically, individuals, you all can make up to $150,000, and then if you're married filing jointly, it's double that. And that's going to be with everything, whatever the individual can deduct. Married filing jointly, since it's two people, you get double that income threshold, right? So it's $300,000 for, I didn't put that in there, but it's up $300,000 for married filing jointly. Now, the other thing with the tips, so the other thing is overtime. So there's also no tax on overtime up to, right, up to the $12,500 for individuals. And again, as you see, it's the double for the married filing jointly. So up to $25,000 for married filing jointly. The thing with this too is businesses. So if you are an entrepreneur, if you're an employer, let me say that, if you actually have employees that you're paying, there's going to be certain document requirements that you're going to have to start doing in this year, 2026. There's also going to be new fields on the W-2 form that will allocate this information over to. So it's going to be very important for those of you all who are employers to work with your accounting and tax professionals very closely these next 3 to 4 years, because all of this is also is limited, right? And that's why I put in there, it's from 2025 to 2028. Unless Congress decides to extend it after 28, we won't know that until that time frame. So for now, this is a really good time for entrepreneurs and business owners to really take advantage and do some planning and strategy these next 3 to 4 years, because there are a lot of benefits in the new bill that does actually help businesses. So the next thing is the child tax credit that people are talking about too. So the child tax credit was raised from $2,000, they added an additional $200 and they made that permanent. So instead of it fluctuating, I don't know if you remember a couple of years ago around that COVID PPP timeframe, they had raised the child tax credit all the way up to like $3,200 at one point. So normally it's always been around that $1,000 to $1,500 to $1,800 range. So now they've just decided to make it a permanent $2,200. Now, I do also want to state this. That is not a full $2,200 credit. That's why I put on there refundable up to $1,700 per child, right? So some people think, oh, $2,200 automatically is what I get per child. And again, that's not true. Taxes is based off of your income. So someone someone with a lower income range may see the full refundable tax credit of up to $1,700. And then someone who makes maybe, $80,000, they may see $1,000 of that refundable credit, right? So everything is based off of your income and what you're actually filing on your tax return. I really want to stress that, because I feel like a lot of people think taxes are a one size fit all. And that's the biggest myth that I have to debunk with most people. So it is a refundable credit up to $1,700, but that's pretty good. If you have 2 or 3 children, right? That could be a decent amount of money that you can possibly receive back on your tax return. So,
Patrice, I had a quick question for you. So in the tax law for the tips, if a person is the employer, like if I'm the business and I'm paying them, before I had to pay taxes on their tips that were reported as well as they had to pay taxes. So do the employee get the tax break and the business owner, or just the employee?
In this case, this is for the employee. Yeah, not the employee. The employer,
I had to ask.
Yeah, the employer will have to report it though, which will help, because it's gonna bring down that expense for you when you actually are doing your taxes as the employer. But as far as like the deduction itself, that is for the individual. Yeah. So this is more on an individual base with the no taxes on it. So that's another reason why people like it, right? Because your employee, they were paying taxes on their tips, and some people were when it shows on their W-2, because some W-2s did show that they got tips and they were paying taxes on it. So I really like that. I felt like that was a good bill for them to pass, the no tax on tips and the overtime, because you do have a lot of people who work overtime as well.
What is your take on these all of the sudden new changes drastically? Do you think this is a Trump thing, or do you think this is kind of like it was just time to make these changes? And I know that's a weird question, but it seems like all of a sudden we starting to get a lot of the past couple of years. It seems like, and I'm not in your world, but it seems like we're starting to see a lot of tax strategy going on a little heavier than what we used to see.
We are, and I'm gonna be honest, and I'm gonna say this, and a lot of people don't like to hear the truth, but the truth is when Trump got in office the first time, he was the one who actually increased the standard deduction then. It was a time when I was doing taxes, people were only getting like a $6,000 standard deduction. He was the one that changed it and doubled it to 12,000, the 18,000 for head of household. So a lot of people don't know that, you know, him and his you know, when he had Congress and Senate, all of them, when they first started, they were the ones that actually started this whole increase, right, in these different type of deductions, and a lot of people don't know that. So, and I do think that that is more because he does come from a business world and background, that's more why these conversations are being had. You know, everyone likes to say, oh, the rich just want to get richer, and that could be true. But the thing is, what we have to understand is corporations and small businesses really run the country, right? A lot of people work for small business owners, and a lot of people don't know this. Small business, in the eyes of the IRS and the United States of America, is a company that makes up to $500 million, Natasha.
I know from my certifications, it's crazy.
It's right. So
I didn't know that until I had to get certified as a small minority business. That's when I learned that.
That's when you learn that. Yeah, a lot of people don't know that. So people think when we say small business that we're just talking about small mom and pop shops. We're not, right? So we're talking about companies that make up to 500 million. They consider that small business. So just think about that, right? But so you do a lot
nothing.
Yeah, a lot of the companies that people work for are small businesses. So yeah, I mean that's just the bottom line is, yes, I do think that a lot of this has come in from them, and from that era with Trump coming in, and that's again because he's a business person. So when you get that, then they're going to start having more of these conversations. So right now, take advantage of it. For those of you all who are here, right, from 2025 to 2028, this is what you have, right? So we'll be able to see if that gets extended. And actually, the Tax Cuts and Jobs Act from 2017, again, which is something that him and his regime implemented, right? A lot of people don't understand that your taxes went up and you got a bigger refund because of that. So that also got extended. So that, that's another phase in that's been brought over. The newer thing is the senior deduction, which I really do like, right? Which is the senior deduction. So you do have to be 65 and older. If you're an individual, you can have up to a $6,000 deduction. And again, if you're married, filing jointly, it's always double whatever the individual deduction is. So if you're married, filing jointly, seniors can have a deduction up to $12,000 of their income. So
is that in addition to? So basically, the regular us under 65 have their deduction. I think on the screen that was like $2,200.
So the prior screen. So that's just for tips. Another $2,200 was for the child tax credit. Right. I didn't put the standard deduction up here, but the standard deduction, it's an additional too. So the seniors are going to get the standard deduction, and then they're also going to get an additional deduction of being a senior as long as they're over 65 and over.
I'm hoping that you listening, Ma. I'm hoping that you listening.
Look, I told my mom, you gonna start filing your taxes this year too, because I normally claim her. But I said, with this new senior deduction, we gonna file your taxes this year, Mama, and see what you get.
I know that's right.
Because that could definitely help seniors out, because it is in addition to, which is great. So, and it's temporary, same way as the other provisions. It is temporary. So it's from 2025 up until 2028, basically. And the standard deduction did raise, and the standard deduction does normally raise every year. I didn't put the full chart of the standard deduction down, but it did go up. I think I put it here as saying joint is $32,000 and single is up to 16,000.
That is
A
crazy.
household, you're writing off like 23,000. Want to say I did a tax return last night. I think the mom got a deduction of like, it's like $23,265 or something, right? So last year it was like 18,000. So yeah, it's definitely gone up. And again, when you have the standard deduction increase, that is more income on the tax return, because that same mom that I did last year, income didn't change, same children. Tax return was maybe like 3,000, and this year the tax return was like $5,200. That's like a $2,200 increase just from that standard deduction being increased.
And I had a quick question. So if somebody is married and they're separated, so they're filing head of household at one place and they filing married living separate, but they're each like in different addresses. Is it better for them to just file jointly, or is it better for them to just file married? Because if they're married but they're separated, so they're living in different households, so they're both head of households in different places, but they're still not divorced.
So that's a good question. And it's gonna depend on a couple of different factors. But
look at your face.
but I'm glad that you said that they actually have separate households, because if they were,
this is what I see in doing mortgages. This is the stuff I see. So I'm trying to ask the questions that I see my clients.
Some of the people, okay, because normally
and some of them my own questions. So y'all won't know which ones is which.
Of course, right. That's why we just say clients. We just keep it real like that. I'm gonna say this. Normally, when you are married but filing separately, you don't get the deductions and the credits. You don't get the child tax credit. You don't get the earned income credit. You don't get the special different type of credits, because they really penalize you if you're married and you're filing separately, right? Now, in this case, what you mentioned in that, the fact that they have two separate households, so they have two separate addresses, and they may or may not be, and it has to be a certain time frame that they've been separate. Like if they have a actual separate, what is it called? A separation decree? That's the divorce decree, a separation agreement. Because on the form in the tax IRS system, it asks us in the tax software, it asks us questions like that. Like, do they have a divorce decree? Do they have a separation agreement? Has it been longer than 6 months from them not living in the same home? And then that is also going to play into if they have kids. Who can claim the kids? Which one can claim the kids? How long were the kids living? Were they both living in each parent's house 6 months out of the year? So it could be some other deciding factors to that. But let's say that they have been separated for over a year. They both have different homes and addresses, right? They could also possibly, one of the parents could file one of the parents could file as single if they don't have any kids. Maybe the mom took the kids and the dad lives separately on his own. And then the mom could possibly file as head of household if it meets those requirements. But most of the time when you're married filing separately, you have to file as married filing separately. And that usually phases you out for a lot of the credits and a lot of the credits that you'll get, because tax credits and tax deductions are two totally, completely different things.
Got it. And my last question on that is is there an income limit on being able to get the standard deduction?
Is there an income limit? No.
Like if somebody make $300,000 and somebody make $150,000 and somebody make $1 million, if you're head of household and you're married, do you get the $32,000 regardless of how much income you make?
So normally, yes, but can it be a phase out? Yes, it can, especially once your income starts reaching that over $300,000, $400,000 tax range. Yes, it can actually phase out. I'm sorry, let me just respond to my assistant and let her know that I'm on. But no, But for standard deduction, no. Regardless of whatever your income is you're still going to get that standard basic deduction.
Got it. Okay.
And
if anyone has questions, please put them in the chat. I know that we are live on Facebook and Instagram as well. So we do have someone trying to help us pull in the questions because we're on a few different platforms at the same time. But please, drop in any questions you have. We definitely want to get them answered for you.
Yeah. And that's the only one that really doesn't phase out is the standard deduction. But all the other ones like the child tax credit, the senior deduction, overtime, all of those do have a phase out. Now, another newer one is this auto loan interest, which I kind of like, right? I kind of like that they threw something different in with the auto loan because a lot of people buy cars, which I think we both see too in our world. I know you have to tell these people, do not buy a car while you are buying this dang on property.
Can you please say it again? Please say it again. And we're going to get to that too for all my buyers that's tuned in on because we have write-offs that like depreciation and miles that I can add back
in, right?
Even expenses on your home, if you can document it with a receipt and proof you paid them, I can add that back too. So we're going to talk to them about that as well. But definitely, thanks for bringing that up because definitely that is a thing.
Yeah, that is definitely a
thing.
Don't
buy the car before the house.
Right. Get the asset, okay? Get the asset. Get that building first. So this other newer deduction that they put in is this auto loan interest. And I do also kind of want to just go over the auto loan interest a little bit more because like I said, it does, all of these things kind of have a little stipulation to them, right? So with the auto loan interest, where's my notes on that? Okay, so who can claim it? So one, the loan has to be done after December 31st, 2024. So basically it will start January 1st of 2025. So if you purchase the car starting January 1st, 2025, which would have been last year, and we're filing last year's taxes, then this could qualify. It does have to be a U.S. assembled vehicle. I was like, okay. So when they put that stipulation in, that whole, trying to bring back and making manufacturing here in the United States relevant again, I see now some of the things that they're doing. So a qualified vehicle, it has to be assembled in the United States. You can have cars up to 14,000 pounds. So it could be a car, it could be an SUV, it could be a pickup truck, it could be a van, right? The loan must also have been secured by the vehicle. So it cannot be a lease or an unconsumed consumer loan, right? Some people go and get a personal loan and then go and buy a car. You won't get the deduction. It has to be an actual auto loan with interest and things, because we also know leases are a different type of agreement than an auto loan by itself. So, and it has to be for personal use. So normally we can remember the deductions that we get in business. This is also something for people, because people are always like, oh, I can't write my mileage off. No, because you're not in business. Remember, W-2 wage earners can't write off their mileage that they're driving back and forth. So this is like a way for those of you all who've been asking for years, why can't I write off my mileage? Why can't I do, right? So now if you have a vehicle that is for personal use, and it was assembled in the U.S., it has to be a brand new vehicle as well. And then again, the loan had to originate after December 31st, 2024, which I'm basically going to say January 1st of 2025. So if you meet all of those requirements, then you can write up to $10,000 of interest off on your taxes, which I think is, I like that. I think it's something newer that gives people a different type of deduction. A lot of individuals over the years being in this industry for so long, I've heard complain about that. So I think this is something on the individual side that will help. And they're hoping that it will increase Americans buying American-made cars again, because we know a lot even drive foreign right now, but a lot of people drive foreign, right? So sometimes when you have a tax incentive, then that also will help people, bring back the whole U.S. space of cars. So I think I see a question in the chat.
Yep, I got a few questions, so I'm going to go ahead and ask them. I think these came from social media. So, as a financial consultant at a bank and credit union, would I qualify for the tips deduction?
As a financial consultant at a bank and credit union, no, because you don't get financial. I haven't worked in the banking industry in 13 years, so maybe something has changed, but that industry is not a normal industry for you to receive tips. Now, are they giving you tips at the bank now? Look, I used to get a little lunch box.
Because you may get commission and bonuses, but tips would be something like if you waited on someone and then they gave you a service fee. So we have commissions, we got bonuses, and we got tips. So if you are getting tips, then I would say yes, if it was a customer could give you tips, but I think you may be speaking about commission or bonuses. And I think that your answer is no to the commission and bonuses, right?
Yeah.
Because if they stop taxing commission and bonuses, let me tell you.
So y'all will be winning.
I will walk different. What? And my next question is, do the service providers for tips qualify for consulting services?
See, and this is some of the questions that they're gonna be looking at. But in the actual IRS publication, it does say service, right? It does use that word service based. So I am looking at it. And then it is also going to be by interpretation a little bit. But from myself and others in the industry, we're looking at more service based. So if you are, a waitress, and you're working in the restaurant workers, some manufacturing workers, but most of this is more than likely going to be for those types of situations. Now, again, if you are in and it also has to qualify with what your industry standard is, right? If your industry standard, like that person that was working in financial and banking at a credit union, banking and credit union industry is not a standard industry that receives tips, right? So that's also what we have to look at, is your industry is something standard that receives tips. Consulting, you may or may not. I mean, I've had a client give me a tip or buy me dinner or, bring me a gift, but am I writing off every single one of those things that happens? No, because it's not a normal industry standard in tax and business consulting, if that makes sense. Right. So it still has to meet industry standard requirements, but it also still has to make sense. Y'all, I don't want y'all out here just writing off stuff and then you get audited and the IRS is like, no. Right. So some of you may have to, have a deeper conversation with your tax professional because they know your situation way better than I do. You got any other ones, Natasha?
That's all I have for now.
Okay. Then we will roll on to this next slide.
I might be filing joint this year, I'll tell you that.
Hey, it definitely for the married folks, it definitely think it helps.
That's a big deal.
Yeah, like I said, because a lot of times when you're married filing jointly, you don't get it. They basically penalize you.
Right.
So this one is just saying basically that, like I said, the Tax Cuts and Jobs Act from 2017 had expired, and now it got extended up until 2028. The other thing that we see is this SALT tax. So the SALT tax deduction, and again, Natasha, this is something that we kind of see in our industry. This may or may not work with, every single person. But the thing with the SALT tax is it was down to 10,000, and the SALT tax is state and local tax deduction. If you don't know what that means, state and local tax deduction. So most people who see this deduction itemizes on an itemized Schedule A form, basically. So like some of the clients that you may have that are in what's a area that the property taxes are over 10,000.
Calumet City, South Holland, Orland, everything
right.
South suburbs.
Everything South suburbs.
No
basically. Shade. Right. Everything South suburbs. So some of my clients that are in the South suburbs were really upset that they put that $10,000 cap, because they're like, my taxes are $20,000. My taxes are $18,000. So I'm leaving money on the table. And I know it's not something that I wanted to do. So I'm glad that they did increase it on the local level. Now the deduction is up to $40,000, which is great, because now the people, and we know that, unfortunately, property taxes went up at the end of last year. A lot of our South suburb clients got hit hard. Right. So some people really do have a $30,000 tax bill. Right. And people don't understand that. So at least now they can write that off on the state and local side. So on your state return, if you're in Illinois or whatever state you're in, every state is different with their taxes. But in Illinois, now, instead of you having that $10,000 cap, we and I actually have to double check that, because I'm gonna be honest. Illinois said that they are not going to honor some of the federal tax increases or changes. So I do have to double check the state of Illinois website to make sure, because like I said, every state is different. But we do live in Illinois, and we should be getting that up to 40,000 SALT deduction. But I do want to verify that, because I have read some articles where Pritzker was saying certain things he wouldn't honor, which just doesn't make sense to me. But that's a whole nother other topic and conversation for another day. So let's just say for now, we will be able to take that deduction. So, and it is a cap on that. And that's why I put for taxpayers making less than the 500,000. As remember, I stated that with the with some of these deductions, there are income limitations, and this one is also one of them. The SALT does have the income limitation.
What was it before?
So more recently, they capped it at 10,000. So I can't remember what it was before that.
Got it. Okay.
Yeah, I can't remember off the top what it was before the cap of 10,000, but yeah, they capped it at 10,000, but now they came back and took that cap off and raised it all the way up to 40,000. I can't remember where it's ever been 40,000. I'm gonna say that. So whatever it was before, it wasn't 40,000. So again, I will say that I feel like they did look at some things that I think the American people have been complaining about. So we'll see, because this is new. This will be the first year utilizing these as well. So a lot of things will be different. Now, the other thing that I wanted to bring up was, and that's what I was saying, boost for businesses. So businesses, again, if you are a business owner, entrepreneur, or employer, okay, you want to be real strategic these next 4 years. And you really want to sit down with your tax strategist to really devise a plan. And I like how Natasha stated that earlier in the beginning, that a lot of people do the thing and then contact a tax person or CPA later. And that's the worst thing for you to do. Really, what you want to do is you want to be having these conversations with the tax strategist before you do it. If you're looking to buy a G-Wagon, contact your tax person first before you do that, right?
I'll be calling from the dealership. I'm about to buy right now in 5 minutes, but I got one question.
Right. And that's the thing. The people who are and I like to just use it as an example. The wealthy consult with their professionals before they do things, because everything that you do, you want to make sure that it's going to be a benefit for you, right? You want to see that it's going to be a tax benefit. It needs to be a strategy that we are having and putting in place. So these next 4 years is going to be very imperative for you to sit down and devise an actual game plan and strategy for your purchases, these big purchases that you want to do. And one of the biggest things that they've done too is this renewable energy, right? And this renewable energy includes individuals and businesses. Some of them are EV purchases, solar installations, facility improvements. So companies like restaurants, farms, if you are in manufacturing, this is a great time for you to be sitting down and planning out your purchases, building and improving on your facility, because now we have the full, you have, and they increase the bonus depreciation back to the 100%, right? And so that's a big thing for those of us in business. For those of you all that are in business looking to purchase, buy property, looking to improve on your investment property, maybe you have a facility, maybe you want to add on to it, bringing in solar panels, energy efficiency, all of that right now is something that you can really take advantage of with this newer tax code that we have for these next 4 years. So like I said, you definitely want to be having these conversations with your tax professional. Any questions around that part? Okay. The other thing I want to say is you want to be heavy with, I got the salt cap on there twice. You want to be heavy with cleaning up your accounting systems and your bookkeeping systems. If you do not have these things in place right now, then I suggest that you get them in place immediately, because again, with all of these new changes, this is going to be something that's one of the biggest things that the IRS looks at is your accounting and bookkeeping, right? For all of this, for how you're utilizing these expenses, how you're taking these different deductions, all of that is going to play a major role. So you want to, if you don't have your accounting system set up correctly, I need you to definitely get on that this year. This other thing that is new is this thing called Trump accounts. All right. And I like this as well. So the things with the Trump account is it's for brand new babies, basically. The child had to be born in the last year of 2025. And then right now you can possibly qualify for $1,000 funding, it's called a one-time government seed contribution. This, I've never heard of the government saying we're gonna put $1,000 in the retirement account for your children, right? So this is something that parents with new babies can really take advantage of. Everyone, now they haven't really broken down who and how people are going to get funded. Like if that's going to be some type of lottery, maybe we'll see. But let's say you don't get the $1,000 seed contribution, you as a parent can still contribute to the account, right? But the thing that I do kind of like about this is it gets parents talking and thinking about retirement accounts at an early age for their children, right? And I think this is a conversation that really does need to be had, because I've definitely started having this conversation more, even online with my social media platforms, about the importance of investing into a retirement account. And more importantly, outside of just your employer, because a lot of people only have their retirement account with their employer and don't have their own separate retirement account with like a Fidelity or Charles Schwab or something like that, which I have definitely been talking about more and encouraging people more to do. So I do like this whole Trump account thing that he has set up. You can contribute up to $5,000 annually. The children have to be birthed between 2025 and 2028. And again, it's a $1,000 government seed is what they're calling it. So the government will actually contribute the $1,000 for the account, right? Which is again great because $1,000 can grow to a huge amount in 21 years. Once the child turns 18 to 21, right? Then now you already have a whole fund that's already been set up for them at a very early age. So again, I like this. I don't have a problem with this. So I don't think, and I haven't heard a whole lot of conversations about that. So I wanted to bring this up. And then I already went over that SALT cap, so we could skip past that one.
One quick question for you. For the Trump Act, is this set up automatically?
So no, it's not set up automatically, but depending on who you're filing your taxes with. So when I filed a couple of clients' taxes last night, there is a form that I can fill out that elects for them to open up their account as we're filing their tax return. So it can be done when you're filing your taxes right now. You can actually click the button that says, yes, you want to open up the account. That allows it, and then it will create the account and information from there. So this again is new. So this will be my first time doing it and processing it for a client. I had a client yesterday that actually agreed to it. Like I said, because at this point, the way my software brings it up is it's offering it as opening it up and receiving that $1,000 seed contribution. So that's the way that I presented it. And the client said yes. So we filled the form out. So once we actually submit the tax return, I'll be able to see like what that full process looks like. But yeah, it to me, it's, to me, I don't have children, but if I had a child and the government said, hey, we're willing to open up a IRA account for your newborn baby, and we're going to give you the $1,000, the up to $1,000 to fund it, I don't really see, why I wouldn't do that. And then, like I said, parents, you all can contribute up to $5,000 as well. So it's a different type of account. It's not the same account like how you have your Roth IRA and your regular IRA. It's called the Trump account, but it's for it's for your children though. It's for they call them seed babies, 2025, who are birthed from 2025 through 2028. Because remember, all of these provisions are through 2028. So we'll have to see if they get extended, with the next administration.
So you telling me all the new babies born in 25, 26, 27, 28 need to have this going on for them. So instead of giving them a $5,000 birthday party, you can get them a small gift in this, and then they can benefit from it later.
Come on.
People don't understand when they start getting these type of gifts. These the best gifts. I've been to a lot of birthday parties, and they get like my mother used to give my kids the little, what do you call them? The little checks, the little money, not money orders. They little certificates or something.
Oh, I know what you're talking about. The what they call.
And they be like, I don't want this. I'm like, yes, you do.
Yes, you do. Bonds. The bonds. Yeah.
And they double
my grandparents used to give us that as a birthday gift. We didn't understand it back then.
I didn't understand it until we couldn't pay my tuition and I couldn't graduate. And my mother pulled out this box of them and she had to cash them all in just to pay for our tuition. So that's when I learned about a savings bond.
Yes. So exactly, Natasha. Instead of giving the baby a $5,000 birthday party, and some of these parents are throwing $5,000 birthday parties for 2- and 3-year-olds that probably will never remember the party, right? This is.
And let me tell you what I did to my brother. For my little brother, and now my kids get older. I'm like, once you have a kid, then you cut off. And now I'm on to your kid. He like, well, I ain't have no kid. I get cut off because you waited. You should have a kid by now. That's your fault.
Look, you sound like my family. You should have had a kid by now. That's your fault.
Right. Oh. But I was like, you still cut off even if you didn't have kids. You're 30-some years old now. So enough is enough.
Look, he need a regular Roth IRA account now. Go ahead and start putting that money.
Oh, that's a whole nother class. But yep, I have him doing that as well. And I just did that for my kids. So it's a struggle, but I'm trying to give them $7,000 a year to put into their Roths. So yeah, that's going to be a whole nother class that we're going to get them together on those investments and that estate planning. So yes, but Roth IRA is a hot commodity. And I didn't know you could do Roth IRA and you could do Roth 401k. So we're going to bring some people on to talk about that as well.
Definitely.
Go Building Dreams Foundation.
Come on, Building Dreams. Put these people on financially.
Let's go. Let's go.
I think I already answered Tony's question. She said, is it set up automatically? And then Rocky's laughing, saying CDs. Yeah, we had all of that. CDs, we had the bonds, but the bonds is really what's up. Like Natasha said, I didn't realize it either until we had to cash them out one day. My grandparents used to give us bonds every year for our birthday. So I was like, okay, this makes sense. This makes some sense. So I did also kind of want to go over, since you and I deal with the real estate space, Natasha, some of the things that with rental property, let me click on it. I kind of just jumped right into that. I think that so if people didn't know, just some of the costs that you can spread over time when you have residential rentals, for those of you all who might be renting. If you didn't know, residential rental, as far as like depreciation, the deduction that we take, it can be straight lined out over 27 and a half years, right? So a lot of times too, when you hear some of the people in higher income brackets that utilize real estate as their, as a tax incentive, part of that is because when you are investing into real estate, whether it's residential or commercial, you can write off up to 39 years. Residential properties, you can write off depreciation, and it's the same amount if you do it the straight line way, which is about 3.6% of the building, right? So if you have a $300,000 building, you're writing off about 3.6% of that in depreciation every single year, right? That becomes a tax deduction for you as the investor, as the property owner, right? The forms that we fill that out on is a 4562 form. And actually I gave it a little less than that. So we put an example down here, like on average, a $300,000 building could possibly, and I like to say possibly and up to, right? I like to use these terms so you all aren't automatically thinking that you get 10,000, because it also depends on your tax situation, what you're claiming, and how you're set up. A lot of people don't know that when you're a W-2 wage earner and you are claiming your rental property on your personal tax return, there is a cap, right? There's a cap on what you can actually write off. And so everything is also going to be based on how you're set up. Some people have properties in their personal name. Some people have properties in their actual company name. Maybe they set up an LLC for each individual property, which is what a lot of real estate investors do, who I would say that I can tell are more advanced, right? My more advanced investors, when they have multiple buildings, each building has its own LLC, and it's set up that way for a reason. And sometimes we come across individuals who have 5 or 10 properties and they're all in their personal name. So it's a different type of tax write-off and deduction if everything is under your personal name versus it being set up as an actual business, and the income and property expenses can flow through the business name and not your personal name. So that can be different, right? And then also and this is part of that. So for those of you all who are individuals and your properties are in your individual names, a lot of times you'll see a Schedule C tax form on your taxes. Hopefully the person that you're going to is explaining this type of stuff. But when you report all of your rental income and you're able to deduct your ordinary and necessary expenses, because this is the thing with the IRS and taxes, everything has to be ordinary and necessary. And it has to be ordinary and necessary within your industry. Like I said, right? It has to be ordinary and necessary within your specific industry that you're in. And so some of the categories that are on that Schedule C is your mortgage interest, your property taxes, your insurance, your utilities, your repairs, and then again, that depreciation. And I've come across some people who don't write off any of that, right? And so I'm like, well, what are you doing? Because the whole point of you having this investment property is for you to be able to utilize some of this stuff, right? So if you all have property and you've never written off any of these type of deductions, come see me, because whoever you're working with is not giving you the best advice. So they're not even looking at what you have, right? And that is another thing that I see a lot. Sometimes you all are going to people who really are just data entry clerks. They just know a couple of ways to get you a large refund back if you are a low income earner. But those of you all who have property, your income is higher, you have a business and things like that, you should not be going to anybody. You need to be working with someone who actually knows and understands the tax laws, the type of deductions that will work for you, that benefit you. And everything is not always getting back a huge refund, right? Sometimes it's actually looking at your situation and what makes sense. Because the other thing is when the larger the refund, probably the lower your income is being reported. And that's what you have to understand. If you're trying to go to Natasha and buy a $400,000 building and you made $150,000, but you let Pookie and them write off $100,000 of your income, now you only showing about $40,000 in income, she's not approving you for that. You know what I'm saying? And I've seen the income be written off to less than that, which is crazy, right? Because that is a lot of times what will also bring an IRS audit. And we have a lot of people that you can receive the refund today. And I need you all to know this. The IRS will send you that money. If someone is telling you they can get you $20,000, $30,000, $40,000 back, that should be a red flag. Because if your regular tax professional is like, no, your average return to this year is $3,000, and someone says, oh, I can get you $30,000, that should be a red flag, because 9 times out of 10, they're doing something that they should not be doing. They're adding something that they should not be adding, or they're deducting more of your income than they really should be deducting. And a lot of times people get audited within 2 to 3 to 4 years, and then you have to pay that money back. And you're starting all over again. You're going to end up speaking to me anyway, because now you're calling me to fix the situation, right? So instead of doing that, instead of writing off all of your income and working with people who are, like Natasha said again in the beginning, just really trying to reel you in and not really giving you all the details and the explanation. And that's the reason why I am the realist tax and business strategist, because I'm going to keep it real. And we're going to tell you what really is happening and what these people are putting on your taxes that you don't know, right? So you just want to be aware of that. You don't want to write off all of your income. You definitely don't want to, I must just say that you don't want to write off all of your income. When you are planning on purchases, if you know you want to buy a house this year, if you know you want to buy a house next year, you are going to have to sacrifice certain things. And I tell my clients, we might have to be less aggressive. Some years you can be aggressive with your tax deductions and expenses. But when you know that you're trying to go and buy a property, when you know you're trying to buy an investment property, buy a commercial building, start a new business, get a loan, you need to show income. So you cannot write off $100,000 of your income. You get what I'm saying? So taxes are very specific by the year that you're filing them in. And every year may look different. Maybe the last 2 years you were very aggressive with writing off. But now that you know you want to purchase this building, this commercial property, you need to maintain all of the income that you are receiving, and you may owe. And it's okay to owe, right? Because
And I had
the
a quick
asset
question
is the thing. Okay,
I had
go
a quick
ahead.
question from the last slide. So how long can the IRS come back and audit you?
So I like to say up to 10 years.
Ooh,
Yep. So I always
they can
tell
come back for
clients,
10 years,
yes.
but you can't backfile from 10 years, can you?
Nope. You can
But
only
they can audit
backfile
you
up
for
to
10
3
years.
years.
But
You
they can audit you
backfile
for
up to
10
3 years, but they can audit you up to 10 years. And
Yeah.
then in cases in prior years, I've seen it be a little older than that. But yeah, I tell clients up to 10 years.
Got
7
it.
to 10 years for sure. You want to keep your receipts, your documents, your paperwork. And it doesn't have to, it doesn't have to be the actual paper. You could scan it in, take a photo of it. It could be a digital copy. They'll take digital copies, but yes, up to 10 years, you can be audited. And a lot of people don't understand that until they get that paper in the mail, and then they're crying about, now this is I received this letter saying that I owe $50,000. Yeah, because you let Pookie and them put all that stuff on your taxes, and now they went and reviewed it and saw that all those credits were fake and fraudulent. So
And I do want to say for my buyers that are listening, if you're looking to buy a house, in the conventional world, they did change the rules where if you have a business and your W-2, we do not hit you for the losses for your business, as long as they're not the same industry. However, when you mix it with rental income, it gets tricky because I can't use rental income and not take losses because it's a business, right? So we have it's a little bit of chaos in there. Sometimes I can with the rental income, depending on the situation. But like we said in the beginning, let's have a tax strategy call and let's talk about it. It's January. What you guys file will affect what you guys can buy for the rest of 2025. And we do have programs that'll take 1 year of taxes, meaning you could have did it wrong in 24. You could do it right in 25 and buy in 25 with just that 1 year. So that'll be another class. I don't want to keep saying that, but since you brought that up, I just wanted to go. You say what?
Okay. I like that.
Yes.
So you can do 1 year of income now versus the 2. Is that what you're saying?
Yeah, as long as it's conventional. FHA is going to be that standard too, but conventional now you can go 5% down all the way up to a 4 unit. Before, people had to go FHA because that was the only way to not put 25% down on a 4 unit property. Now they can get away with 5% conventional and still have 1 year of taxes depending on their situation. They do have to be in business for 2 to 5 years, depending on what guideline, but that is definitely an option.
Yeah, we need to talk because it's time for me to purchase another property, and I want to do a 4 unit.
I tell all my agents and everybody, let's teach it and let's do it. Let's buy and teach at the same time.
Facts. That's just like a little sheet that I had with the we can skip the QBI rules. And then I had some stuff for self-employed, but we don't necessarily need to go into that if I don't have a lot of self-employed on here. I see you've been on an hour. I think we're gonna have to. We might have to bring a part 2 back and do, because I got a lot of self-employed clients that have a lot of questions. I feel like we need to do a self-employed one in person. Hey, I'm down. We could do that. Yeah. I just did this last week with
I feel like it's a little more intricate and it's like gonna require some touch and feel and conversations in the room.
Some taking some notes and bringing the laptops and stuff out, huh?
And most of my self-employed people do not file on deadline. Most of my self-employed people aren't filing until October 15th. Anyway, on the very last day, I definitely wanted to. Yes, but I definitely wanted my, my regular buyers that's going to rush and get their tax refund on Monday to definitely tune in today to get these tips, because what we learned today is, number one, if you're married, you can definitely get that tax exemption that's much larger if you're not, separating things. And 2, we talked about SALT, and 3, we just know that we should talk to a tax professional before we file. And I know a lot of people can go on to TurboTax and it's a little cheaper and all of that good stuff, but you just want to make sure you're getting the best bang for your buck. Maybe you're saving the $100 or whatever it costs to file I'm not sure what that is nowadays. I know mine has definitely 4 digits when I file. But with that being said, the money that you think you save, and you might not technically save if your refund is bigger with a tax strategist, because they're putting everything together. And most important, if you didn't do things right, like track your mileage, utilize your space in your house for your business that you can now write a percentage off. So if you didn't take advantage of those things, now you can set aside that for this year. My family is doing something a little different this year. And just so you guys know, like I mentioned before, I am the founder of Building Dreams Foundation. Myself and one other person founded this not-for-profit 14, 15 years ago. And the whole purpose was so I could take myself on the journey of wealth. And rates dropped, it got super busy. So now I am 48. Most people don't know that, but I'm confessing I'm 48, and I am on a road of wealth building and just putting all my boxes together. And my family has to turn in all of their expenditures on February 1st through the 5th, because we're going to go over what did we spend, what did we make, and what was our budget. And now what is the budgets for February, right? And that is something we don't do in our households. I know I don't do it. And I call my son Rich. He down at Howard. And I swear the money is spent like water, right? So we think we need to make more and do more. But if we do some tax strategy, if we look at what we make versus what we spend, that is the number one way to save money, just by paying attention to your credit cards and your bank accounts and all of those things in bags that you never opened, didn't wear, didn't need. It's just we work hard every day, so we deserve it. No, you work hard so you don't have to work when it's time to retire. That's why you work hard every day, right? So with that being said, I won't start preaching, but I want to thank Patrice for coming. Please, please follow her. She is always dropping gems on her social media pages. She is a just person to just give you all the great information. You can book her, as you can see, you can connect with her, call her. She's giving you direct access to her, which is awesome and amazing. And yeah, and I don't know if you have anything in closing, Patrice.
Nope, you pretty much said everything. I put my contact info on this screen already, and I'm also I'm about to drop it in the chat, but you said everything that I wanted to say.
And I want y'all to give yourselves for an applause, because it's Saturday, it's freezing outside, and you are here to learn how you can better yourselves. And that is awesome and amazing. And we're going to be doing a lot of that. So stay tuned. You can follow us at buildingdreamsfoundation.com, as well as on all social media platforms. We are going to be giving you so much information this year through the foundation, because we want to make a huge movement. And like I said, for our Black Friday Expo, we want you to come already with your tax strategy together, already with your stocks set up, already with your estate planning done. So that way the conversation and the information is going to connect to you different, because you're going to be on a different mind level, and you're going to be able to take the information to another level on Black Friday and another level next Black Friday, because we're going to keep pouring into you. And if you feel overwhelmed, just take one step at a time and only do what you feel is comfortable, one step at a time. This is no rush. Wealth is not built in a day, it's built over time. And we're just here to connect you with the right people. So happy Saturday, everyone. Thank you so much for tuning in and listening. Thank you, Patrice. I appreciate you, and you have an amazing day.
Thank you, you too.
And thank you, Emeka, in the background on the ones and twos. Have a good day, guys.